A little bit of a rocky day on Friday. The dip, the rally. Monday, the dip, the rally. Tuesday, the dip, the rally, and then the rally, folks. We're back up here, folks, near the old time closing high, not too far away. We'll discuss some good earnings reports. What a ride in CrowdStrike. HPE, did we talk about that yesterday? Dollar Tree not doing so well. 8:15. We're gonna have fun at 8:15. We got some job data coming out. 8:35. Ryan Detrick, Statman do. He doesn't have one. He doesn't have two. He has 10 charts to share with us. It's Wednesday. Pre-market prep. Let's get it started.
Welcome to Benzinga's Pre-Market Prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All right, let's get it started. Trading at the highs of the session. That's up 16 3/4 handle, following through on that strong close, 53.20.75. All-time closing high, 53.45.5. The buck up almost 30 cents here at 104.33. TLT leading the way here, up 8 cents, 92.75. Crude on the rebound trail, up 31 cents at 73.56. Gold up marginally, 540 at 23.52.80. Silver unable to reclaim the 30 handle, up 6 cents, 29.68. Bitcoin back over 70K. That's up $495. 71,580. Let's bring in Triple D. Let's bring in AB. We got some earnings to talk about. We got some jobs data. Interest rates are going down. The Fed is going to cut again. Everyone's very convinced of that, Dennis.
I do think the Fed is going to cut. I just don't know if it's going to be this year. I think we're at the peak cycle. I think we just, like to your point, Joel, maybe we just stay here for a while. But TLT, you can't argue with that rally the last 4 days. You know, we went from looking like we're going to go down and test the lows to nope, just kidding. Boom, boom, boom. 80 and 88 and a half, 89 and a half, 90 and a half, 91, 92, 78. So here we are here this morning, trading up once again on the TLT, just slightly trading higher here. But impressive comeback for the TLT. We know that bodes well, obviously, for the IWM, but the IWM is still having none of it, and it's been leaking here. So you're seeing all of a sudden, which is interesting enough, this disconnect between the IWM and the TLT. So I don't know what's happening here, but stocks across the board. You know, let's just have a general conversation here. You got Nvidia, and you basically got everything else, because I'm looking at a long-term portfolio and I'm like, I'm making so much money in Nvidia. And then I'm like, why is my portfolio not up today? And then I look at all the other stocks and it's like, there is not a lot of other stocks participating. IWM breaking down to new monthly lows. You know, the SPY's kind of hanging out, but hasn't been able to break out. Qs haven't been able to break out. Microsoft leaking. We've got Apple's went the other way. Apple's actually been going up here, but it's such a one stock market here right now. It's like Nvidia goes up every day, and then there's everything else. It's just kind of hanging out. And then if you go into the IWM or into value stocks, those things are going down. And Joel's silent on this. He doesn't even know.
No, because we would say, you say it for so long that it's not good for the market. You know, it's not good to to have such a narrow breath. But I guess if you're in the stocks that
I wish I had. I
higher,
tweeted out yesterday. I wish I had all my money in Nvidia. You know, I've made the call, bought the stock at 400, at 500, at 600. I never average up. Bought it 3 times. And, you know, then I started lightening up, you know, at 800, 900. And I've still got, you know, the original position that I bought. But I'm like, I wish I had more, but not so much even that the stock's going up. It's just that all the other crap. I mean, think about this one. Look at Unity Software. Do you see Unity Software? When did that become, AB, when did that become a $17 stock? I mean, here's, you know, you think you're in this raging bull market. This is the tale of two markets. I had that Unity in my long-term portfolio, and it went up, and I was like, I didn't like that when they were cutting the jobs. And everybody, and they popped it on that news. And I'm like, they're cutting too many jobs. That's showing me demand problems. I said it on the show that day, and I sold the stock at $38 that day, and I took the proceeds from Unity, and I bought more Nvidia. I think it's $620. I think I paid. So, and everybody's like, "Are you nuts? You're adding to your Nvidia position and selling Unity." I'm like, "Look now, that's been cut in half, and Nvidia has doubled. That's like my best trade, one of my best trades ever, selling Unity at 38 to buy Nvidia at 620. I mean, there's a tale of two markets here happening. You know, you got Kathy Wood, ARKK, sitting down near the lows. There's a lot of stocks absolutely not participating here.
Ooh, look at Kathy back here near. Well, wow. We're near the back at the April lows here in the
So
stock.
many stocks. Like, you know, look at the IWM. It's up nothing on the year. What are we on the IWM? I think we might even be red on the year. We're very close to being red. We started the year. Where's the start of the year? I'm just trying to look.
The IWM
like
year
around
to
201.
date is the IWM year to date is up $2.45, which is 1.23%. So, yeah, I mean, to your point, Dennis, you have. I mean, I would say though that it's, and we've had this conversation before when we were rallying that okay, but it's not small caps. And it's back like 6 months ago, and it was just the Magnificent Seven. Now that's basically been boiled down to just the Magnificent One, and it's Nvidia. But I think if you look at the overall market, you do still have. I mean, you look at like the other big boys. Microsoft is trading right around its all-time highs. Apple at $195 a share is now just a few dollars off its all-time high. So I don't think it's just Nvidia, but Nvidia clearly is the strongest stock in the market right now, and is really showing no signs of slowing down or being like, it's not trading like it's this super extended, bubble stock, at least like the way I see it. It hasn't really shown me that yet.
It's been up and orderly, just kind of the slow, steady climb. And I mean, what a pre-split run. Just talk about Nvidia for a second here. Textbook pre-split run. It splits, what do we say, on Monday? Is it Monday?
Yeah,
Is it Monday?
It technically splits on Friday, but then
Monday it starts paying split adjusted.
Correct,
What a pre-split run. We talked about this strategy here. We've talked about, obviously, catalyst-driven trades. This is the pre-split run happening here, and they just can't stop buying it. I bought some extra stock in my trading portfolio overnight. I turn around and I can flip that out for $15. I mean, it's like clockwork. The dang thing's up every day. Every morning, Joel, I come in, and Nvidia's leading the charge. It was down last night in the after-hours session. It didn't even matter. Come in, back up. I mean, are we just going to go straight up, or is there going to be a rug pull before? Like, it's crowded now, folks. Like, you're coming in now. You're definitely crowded. When I added a few shares last night just for fun in the trading account, it's crowded. Like you could definitely, if any analyst or anybody says anything negative, it can have a rug pull.
Yeah, that's true. Yep. But who would?
Like one negative comment, and it could change because nobody is negative on it. So you get like Goldman saying ring the register or something. But then Barron's on the weekend was kind of negative on Nvidia. It didn't matter. Didn't matter. I mean, it's like, the honey badger stock. But, we know this is fundamentally driven. This is also right now. This is the pre-split run. You got $100 here that have been, basically straight up for the split.
As far as the analysts go, a lot of them are behind the eight ball as far as the price targets. So if you think of coming out and saying, "Oh no," down whatever, some of them have to play catch up, right? I don't know who's high on the street, but that's another thing. I remember when Bank America came out not too long ago and said, "Oh, we're raising our price target to 10.20," and like, well, now look at it. Now where they're going to have to be. I don't know about the exact numbers, but I mean, what do you have the split? I mean, the only thing you could look at is this thing has its moves. It consolidates for 3 or 4 days, and then it just makes another move. And right now, until you get another consolidation area, which it doesn't look like it's doing today, actually looks like it's breaking out. You get a consolidation period, 3, 4, 5 days, and takes out that lower band. But boy, oh boy, we'll see what happens with the split on Monday. A lot of times it's not that day, but a day or two after. But no reason.
And then some people are saying it passed Apple and market cap yesterday. I don't have that on the Pro, which does a pretty good job. Just takes the current shares outstanding times obviously the current price. I've got Nvidia today at a market cap of 2.86. I have Apple market cap of 2.98. So it's a little bit of a moving target because Apple, I believe, has a buyback going on. So shares outstanding are pulling back a little bit, and that actually reduces the market cap of Apple. Imagine if Apple didn't have the buybacks going. It probably actually, I guess, that's driving share price higher, but, there'd be more shares outstanding to multiply by. So it actually brings the market cap down, which is funny. It drives share price up, but market cap down when you reduce the share count. I've got Microsoft still clear number one. It looks to me like Apple is just slightly ahead still of Nvidia here, but that could change. Maybe even today that is changing. There was some reports though. So again, it's the current share count with Apple doing buybacks that makes it confusing. It's very close though. They're close to passing Apple if they haven't already.
And Gay Faye wanted to be reminded. Dennis and I need a 200 print in Apple to win that long-standing.
Oh yeah,
bet.
The bet.
Yeah, 194.85. But all right, we got a number coming up at 8:15.
Yeah, so
guys, I said we had to move it along, and we didn't move it along. Let's do CrowdStrike, and then that'll probably take us into the number.
Yeah, so we had some earnings after the close yesterday. They were all, I think, pretty decent reports across the board. So CrowdStrike, of course, the cybersecurity play reported after the close yesterday. EPS came in at 93 cents, beat the 89-cent estimate. Sales came in at $921 million, beat the $904 million estimate. The guidance, the company raised guidance on positive momentum. So stock trading up this morning, 11%, up around $35, right at $340, Joel. So I don't know if that's an important level here on the chart for CrowdStrike.
Yeah. I'm just looking at like the headline number, and I don't know why you would slam this down to 276.
It's the headline. The news algos, man, I don't know who runs them, but there are some head fakes. There's a lot of things going on, and I have not figured out how these news algos make money because it seems like more often than not, they go the wrong way and then they reverse on you here. I'm going to get you the expected move. I'm just looking it up here.
I bet
it was about, just doing my quick math, 16 and 20. So $36. It's up 34. Man, these guys are good, eh? Isn't that something? Man, CC Legator, he obviously, follows us very closely. And he says it's hard to get outside that expected move. Look where it goes to, right to the expected move. Wow.
Well, that along with the pre-market high at 344.26, and then go to the upper right chart here. You have one high at 346.63. So that whole area, I mean, if you could withstand the beating that this took, the street leading absolutely the wrong way into the report, they take it from 360 to 306. A lot of people are getting their money back today. So let's see what happens. Let's just call it that 345 area. Above that, you have the high of the move. Also, you have the expected move in this area. But, man, if you took that heat and rode this thing all the way down, man, you're right back up here at that 340 area. If that was a place that, was a target or an area where you wanted to lighten up, it's there. It's there in a nanosecond and a huge range off that 276 low. 814 AB. Dennis, you got to go wide here. I'm not sure what to expect there.
Yeah, we got the ADP number here.
We have the ADP number, which is typically not the biggest market mover, but right now with all the uncertainty when it comes to the labor market and interest rates, this could end up impacting the markets this morning.
GLT lie detector.
We're looking for 175,000 jobs from ADP. The previous was 192,000. That is the street estimate. It is 8:15. Let's see if we got this number.
Survey says
still waiting for it to come in.
Tight. It's tight.
152,000. Little bit light.
You got the number already? It's 152.
Yeah, 152.
Oh, yep, 152 versus 173 estimate. A little
light,
but the market's not really moving off of it.
Market doesn't seem to care. TLT doesn't seem to
care. Usually the ADP number.
Why'd I go wide? I got to put all those orders back out there.
Usually the ADP number does not move the market as much, especially later this week. We are going to get more labor data, including the U.S. employment report on Friday, U.S. hourly wages on Friday. So tomorrow we get initial jobless claims. So we'll get some more labor data this week that might move the market a little bit more than this one did. But yeah, ADP non-farm employment change up 152. Speaking of jobs and how many jobs the economy was adding. So I saw this on X yesterday, Twitter, whatever you want to call it.
I hear
look
they're
what-
thinking of
we
going
call,
back
we
to
call
Twitter.
it Twitter.
Actually,
Did you
He
hear
actually
that?
put out, Elon Musk put out a poll and said, do you want me to change the name back to Twitter? I don't know how that poll ended up.
I'm sure that
but
I assume that
he
Twitter
did. He
won the
put out a
poll.
poll. He
So
must be
this-
getting that question a lot. He listens to his people though. Like he's done that before where he like goes out there, do you want me to do this? Do you want me to sell shares? Do you want me to, he actually listens to the people.
So
All right, what do you got?
This is from Bob on Markets. This is a screenshot from Bloomberg, basically saying that last year that monthly non-farm payroll prints likely overstated job growth by 730,000 last year, with hiring maybe even falling below zero in October. So basically, a lot of this like strength in the labor market that had a lot of people saying we need rates up here might not be as strong as it looked like. And Bloomberg's headline was basically unexpected spark for Fed cuts hidden in plain view. So that could just be something to watch, that if, they do some more revisions to the downside, that'll just feed into the
They've done
camp of
revisions
people.
in the past. We know this is true.
Yeah. So basically my point is just that, for the camp that's saying that the Fed can and should be cutting rates right now, if you get some data like this that shows that the labor market wasn't as strong as we thought it was 6
Correct.
months ago, that helps feed into that. Now, does that mean that's the exact landscape we're dealing with right now? No, of course not. But it just paints a slightly different picture.
It was weak. It was weaker than it didn't add as many jobs, so that that's good, right? Bad news is. Are we back to bad news is good news? And
I
good
don't even
news
think
is
they
good
care.
news?
Like we have
Well,
moved 1 point on this number. On this
I know.
ADP number, this was an absolute nothing burger. This did not move the market whatsoever. So yeah, we're still at bad news is good news, Joel, from the economic data front. They don't want to see anything hot because they want lower rates. They need lower rates. But today, even with the number being slightly higher, the TLT didn't even move. So maybe it's going to start to move. Maybe money managers aren't at their desk. IWM ticked a little bit higher here. But the S&Ps actually are down about 2 points since the number came out. So we're kind of sitting around here doing nothing. Whole lot of nothing.
Well, and I think, Joel, your question about are we back in bad news is good news, I think that'd be a good question and conversation to have with Ryan Detrick, because one thing that Ryan Detrick nailed and got perfectly correct was that when we started raising interest rates past like 3.5% and you had people freaking out, Ryan Detrick was actually out there saying, hey, this isn't bad news for stocks, because typically you see the Fed raising interest rates when the economy is strong. And when the economy is strong, stocks tend to do well. So there's a chance that once we start cutting rates, stocks are actually moving lower because we're cutting rates because the economy is slowing at a faster than expected pace. And so everyone out there might be, amped up and super excited about rate cuts. And then as soon as we start getting them, you actually see the market moving lower. So I would love to have that conversation with Ryan about, does rate cuts mean stocks are for sure going up? Because I think the answer is no. I still think we're going to get rate cuts. And as long as the economy is not slowing down too much, it should be good news for the market. But again, I'm just curious to hear Ryan's thoughts on that. So we'll ask him in about 15 minutes.
15 minutes. Yeah, we got a leak going on here. Do we hit a high at 53.22? There's not much up here as far as like daily highs and lows, but man, it's just the closes have been important. This area where we just hit was like a 6 and 7 day close area. Yesterday, you had two closes just under 5,300. So next daily high in sight here was last week's high at 53.39. That's only 22 handles away. But right now, selling looks like a little bit of profit taking after that, the nice pre-market. We were basically straight up from the open. And this is really, really first the retreat. I can't even call it a retreat. We're down 5.5 handles from that high, 53.22.
All right, let's
So-
get back to earnings. Or sorry, Dennis, go ahead.
Yeah, I was going to say, can we give a shout out? Start with HPE, and can
Yeah.
we give a shout out to Sammy from T3 yesterday, who brought us this trade ahead of time, and he told us on this show yesterday at this time that he was going long HPE into the earnings because he says just a basic simplistic strategy, stocks that are trending higher and then have pulled back, into the report tend to gap up. And I mean, holy crap, this one worked perfectly here. HPE up 15%. I took a small position of flyer. I thought about you, Sammy, and I was like, you know what? And I bought a very small position on the close. I wish I would have made it a large position, but I was like, I'll take a shot on this. I kind of like that idea. I even said it on the
You
show.
just bought the
I kind of
stock,
like
Dennis,
the
you
setup as well. I was with them. So I'm like, I'll take a small position because, earnings are wild. So obviously, you want to take a huge position. Then you really get killed if you're wrong. And I was like, why didn't I take a huge position? Whenever it goes your way, you're never big enough. And whenever it goes against you, you're always too big.
Yeah.
Isn't that the way it works? Yeah.
This is about as
great call, Sammy. T3 just killing it for us. We love you guys at T3.
How'd you trade
That's
it?
about as biggest move I've seen I can remember here in HPE. We're going to give the numbers there.
Well, he was going to ask, how did I trade it? Is that what you asked?
Yeah, like did you just buy the common stock or did you buy options?
Yeah, I bought the close. I bought the common. I don't trade the options. I bought the common stock on the close. Limit on close. So you put LOC. I was like, I'm taking intentionally through the print just for Sammy. And again, it was a small position, folks. I did not get rich on this one whatsoever. It was like just a little taster. And I sold it too soon too, because the dang thing went 18.5, 19, 19.50, and then it just kept going. Should have just that's what trade. I guess you should have just went to the bathroom again for like 20 minutes. And we saw that yesterday. I need to start doing these 20-minute bathroom trades, or you don't look at your screen. It's like, ooh, this is a pretty good money really quickly. I better take the profits. And then, it kept going.
So the numbers you had, EPS came in at 42 cents, beat by 3 cents. Revenue came in at 7.2 billion, which beat by 370 million. They also raised guidance. So HPE trading up about 15% this morning on that report.
Wow. We talked about this one on the closing print. It just kind of like over 18. It just, there was a gap to fill. Things were kind of wide open. Really no two highs in the same area at all. You blew through 19, you blew through 20. Good volume here. Man, what happened at the beginning of March? Was that a 4-day run in HPE? Could that have been earnings too? The run, going back, if you look at Pro, March.
No, that was
what was
looks
that?
like it should have been earnings, but I don't know. I actually don't know what that was.
Holy
was that when they bought remember they bought Juniper?
Didn't
they buy Juniper? Was that it?
I'm not sure.
Before that.
Look at Pro real quick, and I'll just do a quick technical. You got all the way up to 2090. I believe that's an all-time high here for HPE, right? Because of the reorg and everything. 2090.
Yeah, you could be right.
So
Joel.
I mean, you've leaked a little bit. If that's your target, I think you might have missed it. I'm not. If you're buying this and you think it's just going higher, you want to buy that open and have immediately reaction to the upside. But I call it 2090 to 21. I have to call that resistance after trading. There's got to be some stock in the book, right, Dennis? This is a thick stock. It trade 30 million
there'd be
shares.
some, Joel, but it's 1.3 million shares. There's just not as much in the book anymore. It's why. So I used to 10 years ago when we talked this strategy, I used to subscribe to the book and I look, where's the size in the book, and it's just not much in the books anymore. People just don't, institutions just don't show their hand. It's all algorithms, it's all VWAP, it's all it's all done differently here now. So you just don't see it like you used to. It used to be like, oh, it'll have so much trouble going through 20 because it'll be huge size there, so it's got to chew through that. And that may be the case. 20 is big. It got up there back in March and kissed it. So maybe there's a possibility, but it's just not like it used to be. And I actually unsubscribed from my NYOB. I know you asked me about it. I unsubscribed a while ago just because there's just nothing in there. There's not the orders that there used to be. It's just not a lot of information in there anymore. There's just nothing anywhere. They just don't show orders like they used to.
All right, I'd say, I mean, I don't want to go out and say it's not going to open over 20 because you're 37 cents above that right now. I don't wouldn't be putting an order in to buy 20, but use that as your swing level. If it opens up, boom, 20, pops up 2015, 2020, and then comes back down through 20, then maybe you got a little bit on the downside. But man, if people are caught, shorts are dead meat, open up strong 20 bid, go up and take out that pre-market high. So that's a potential setup in HPE.
And just the difficulty here is shorting stocks making new all-time highs. So you can say
Not
it's
a great idea.
resistance, but I hate being short stocks making new all-time highs. And in this earnings season, how many gap and goes have we seen? We've seen a lot of gap and goes. I mean, sometimes they fade, sometimes they leak. It's usually the ones that leak, and write this down, folks, are the ones that are trending down and gapping higher. There's too many sellers. Like there's snowflakes, that are in these like deaths, spirals down. Gets the lift of $15 and everybody comes in. Thank you, I'm getting my money back. Sell, sell, sell. There's no pain in this HPE. There's no natural seller that's saying, please give my money back because everybody is whole. So that's why these stocks can go higher. So the gaps that go up are typically stocks that are getting into areas they haven't been in for a while, as opposed to stocks getting back their losses from 2 months ago. So, I mean, those are the ones that, usually fail. This is the opposite. This HPE is gapping into a new high. So this is one that has the potential. Not saying nothing is 100%, but has the potential for the gap and go. So I actually would not be fading this move here on HPE.
Mm-hmm. Dennis, you mentioned Snowflake there, and I don't know what day that I believe this was the earnings day right here. This is remember I put the question marks up. That's where it was trading in the pre-market.
Yeah, 180. Never even came close.
Yeah.
And open like 169, 170. People are like, oh, I'm getting a deal just up at 180 in the pre-market. No, you're not, because we're going to crush this thing. Institutions are coming in. Just, valuation Snowflake is just crazy. And again, the tale of two markets, AB, that we started with here. Cloud stocks have been an absolute mess this year. CRM obviously has bounced back from the lows, but not looking pretty. Workday, disaster. Snowflake, disaster. Cloud, been a disaster. There has been a lot of bad stocks in this bull market of 2024.
Dennis, what about this? I just want to go back. Someone, I don't know if they got out of bed late, but they were asking about CrowdStrike here. Now, strong long-term up. I mean, strong move off all-time highs. You had a wicked sell-off from 360 to 305 and a half. I mean, so I'll just be looking at this pre-market high area. Do we have it right here? Is it the highs of the pre-market session? Yep, 343. No, we've been higher than that. The pre-market high is 44.26, and I would just keep an eye on all the way up to 46.63. That's your 4-day high. If people are going to come in to sell it, I think it'd be at that area. Of course, there's more room on the bone after that, but already having the expected move, pretty much being equaled. So keep an eye on that, just right there between let's call it 345. Make it nice and easy. Gets back up to
It's a tricky
345.
one. You're
This
not
is a
gapping
tricky one.
through resistance. It has been a historically strong stock, so there's not a lot of bag holders in here, but there's bag holders from the last week. It's a tricky one. I'd say I'm not swinging at this one. It's up at the expected move. If anything, I would ring the register. Like in HPE, like I said, I probably, obviously, I was trading the thing, I'm already out, but, that was an earnings trade. But, if I was a holder in an HPE or making new all-time highs, it's usually a better setup. This one's not quite up to there, but it wasn't going to probably get there just like that. Very important for CrowdStrike today to not start leaking. You want to see it hold. Obviously, it's been a darling, but there's a lot of weakness the last 4 days. So you got some people that are being made whole from the last 4 or 5 days. Those are natural sellers.
To your point, Dennis, just about cloud stocks, getting crushed. Well, after Dell's earnings, and we could talk Dell for a second because I think you tweeted yesterday that you opened a position on Dell. I mean, okay, so Dell reported earnings. Obviously, the earnings did not meet the mark. Stock got crushed like 20%. It was trading up.
It was the guidance. It was the guidance.
It was the guidance. It traded up a lot into it. But when you started looking into it, I think they said that the AI, the money that Dell made from AI servers like more than tripled over the year before. And I was just looking at it. I was like, do people think this is gonna stop or slow down? Like, I was like, this seems like really good news that Dell's making all this money on the AI. So I wonder if that's it. Is that a lot of these cloud companies now are like losing? Companies are paying companies like Dell and Nvidia to go to with the AI servers that maybe some of that business would have gone to the cloud companies in the past. But I mean, like something like that, I would be very bullish on that part of the business for Dell. And then the question becomes, can it carry the earnings like we've seen for, AWS do for Amazon or Azure do for Microsoft? And I think the answer is yes. So I might join you here, Dennis, and take a stab at Dell down here.
I took a half-size position. When I take half-size positions, I'm not fully confident in it because you're kind of trying to catch a bottom here. But, it was Jim Cramer that talked me into it. I already had it written on my sheet, actually, because I was getting interested. And then Cramer made a full pitch on it. And he, went full out and saying, I wish I could buy this stock, but I've talked about it now. And CNBC has a rule that he can't buy it if he's talked about it over the last 3 days or something. So he's got to wait 3 days to buy it. But I'm like, he made, arguments that similar to what you were just making, that when you dig down in this quarter wasn't that bad. The AI components, obviously expectations were super high. We know that coming in. We were nervous about this print coming in. But you just lost $45, from those highs. And you got back to where you were March, April, and May. And now you still have this as a potential AI play trading at like 18 times earnings. It's not super cheap. It used to trade like 12. HPQ trades like at 11 or 10 times earnings. So it's a cheaper one, but also, Dell's got the more AI story to it. Obviously, it's been mentioned with Nvidia. You had the golf ball. There's more revenue coming from AI here in the future for Dell. I took a half size because I starter position. If it comes in, I'll add to it. If it goes, well, I'll make money on a half size position. And Spinner saying, don't do it. Don't do the Cramer trades. But I'm telling you, I said this in the last year. Cramer's hot right now. He has been ice cold for a lot of years, but not this year. Since Nvidia, he's been on the bandwagon. He was on Eli Lilly. Cramer, whoever is working at Mad Money, they've got some analyst that is absolutely killing it because we know Jim Cramer, he'll come up with some picks himself, but he's got a team at Mad Money. There's somebody in there that is absolutely killing. Maybe they're listening to PreMarket Prep because some of our ideas show up on the show as well. But right now, in this last year, I'm giving the Mad Money team and Jim Cramer props here because I'll tell you, Jim Cramer has been very hot in the last year. You can all point out there's going to be a trade or two that he's not done well, and everybody has those. I have AAL, as a half size position because I sold part of it. It's bad. I've had some bad stocks too. I've had some great ones, I've had some bad ones.
Is that what you said?
I have AAL.
American
I have American Airlines. I bought it as a value play, Joel. 8-9 times earnings. How can you go wrong? Why would you go wrong? The market doesn't give a crap about, AAL. The market doesn't give a crap. The PE can go down more. You gotta have stocks in your portfolio where the market actually gives a crap. It doesn't give a crap about AAL.
Yep. Steve is
no
noticing
story here. No AI. No story. Just and breaking down, and then all of a sudden, wasn't going up on peak sales. Now you get a little bit of a decline there. Kill it. Yeah, value trap. Talking against my book again.
All right, it is 8:34. I see our special guest of the day hanging out backstage. One of our favorite guests here on PreMarket Prep. Carson Group's Ryan Detrick. I see him hanging out backstage. Let's go ahead and bring him on a minute early because we've got a bunch of charts to get through this morning. Without further ado, let's give Ryan our very special PreMarket Prep welcome and see what he's got for us today. All right, Ryan Detrick, good morning. How you doing?
Good morning, guys. I'm excited to be here. I think I might have set a record for charts. So, yeah, I know. There's just a lot going on. So, I'm excited.
We got to get into it. I don't know if you were listening earlier, but I gave you some props where you were dead on and saying, like, everyone was freaking out when we started raising interest rates above 3%. I don't know how long ago this was now, a year and a half ago. And you were saying, wait a second, stocks tend to do well when we're raising interest rates because it's usually it's usually with a strong economy, which is good for stocks. Is the same true for the other side, that everyone might be excited about rate cuts, but then the underlying effects of why we're cutting rates actually bring stocks lower?
No, that is a great point. Thanks for remembering that. And we've been in that camp that, listen, higher interest rates aren't bad because it probably means the economy's good. Earlier this year, when they said 7 to 6 cuts, we're like, whoa, if we see 7 to 6 cuts, it probably means bad things are happening. But I will say this, and we've talked about this before in our shop, but if you have a couple of surgical cuts because maybe they kind of hiked a little too much, kind of a la the mid 90s, it's kind of that scenario we keep seeing. We don't think it's that bad. I believe if they cut 4, 5, 6 times, yeah, that's probably a problem. But I've got some charts to say this. We still think there could be 2 cuts this year, is more kind of surgical. Again, inflation's coming back, like I'll talk about here. But big picture, a couple of cuts would be perfectly normal and okay. But multiple cuts, yeah, then that could be the problem area, so they say.
All right, well, Ryan, let's get your charts up and we can start
let me
ripping
see
through them,
here.
because I am curious. I mean, once we started getting some of this lighter economic data, a couple weeks ago, I was saying that too, like, oh, rate cuts back on the table. A lot of people are like, no, AB, you're crazy. Inflation's still too high. So I'm
Right.
curious what you have that shows that you do still think 2 rate cuts on the table for 2024.
Yeah. Do you see election years are still strong, hopefully?
We do.
Perfect.
Yes, we do.
All right. So I've shared this chart every time with you guys. I'll just do it quickly. Last year, pre-election year, normally pretty strong, especially with the first term president. Boy, oh boy, that played out. And then this year, 10 of the last 10 times you had a president up for re-election, like we currently do, obviously. The market's been higher, 12% average. It's ballpark where we are on the S&P on a total return for the year. We still think there's some more upside, as I'll discuss. But that's just big contextual things to think about, that election years, we hear all these things, 2008, 2000, 1960. Those were lame duck presidents. And I know there's different scenarios in those particular years, specifically tech bubble, GFC, but just big picture, election years usually do just fine. Now, here's a cool one seasonality wise. I'm aware April's usually strong. Well, we were down, almost over 4% or so in April. Then we had bounced back with an over 4% May, but just be aware June and August, which usually aren't all that great of months. We know that. And an election year are strong. So we've been on our shop saying there could be a summer rally for a while. And I'm going to kind of cheat a little bit saying summer started in May here with some of this rally, but we're not too surprised by this. And I will say I looked this up. The times you had more than 4% drop in April and more than 4% gain in May, it's like super, super rare, because normally the opposite happens. It was like 1936 and 1942. So like that was like right before World War II started in 42, and 36 was a very contentious time with the Olympics and Germany and Hitler and all those things. But you know what? The rest of the year, those 2 years, guys, gained almost 20% from the end of May through the rest of the year. So just think about that. We have a washout in April, strength in May, but I'm going to dig in a little more. When you gain at least 4% in May, and I thought this was funny. Maybe a sign. I don't know. It's early in the morning. I thought that was funny. Maybe a sign. Get it, May. Anyway, so when you have a strong May, an abnormally strong May, like we just did, we just gained over almost 5%. Just missed it with that late rally that we saw last Friday. But nonetheless, June it is one of those. It is what it is. You see it here. June's up 8 out of 10 times, up 1% on average, median higher. June's down on average, right? June's usually not a good month. I mean, we know that. But when you have a strong May, you tend to get continuation, and check out the rest of the year. It is what it is. Median return darn near 13%. Look at the last couple times, 2020, 19, 2003, 1997. The rest of the year gained double digits every time, right? So just imagine if we gained double digits in the S&P, how angry some of these bears would be. But so again, these are some reasons we've been overweight equity since December of 22. Come on, you the whole time saying we still think stocks are the place to be. Stocks still look pretty good to us, and that is still, these things don't see any changes when I see these. Couple more here. When you're up 10% for the year as of the end of May, like we just were for the first time in 3 years, you see it here again. June usually does better than average. And the rest of the year, again, pretty strong returns. Rest of the year up 16 out of 19 times when you're up at least 10% as of May. So again, just some things to think about. That's like double the average returns as you see there. So just some contextual things to think about. Now, big picture, this bull market is about 20 months old, give or take, from October of 2022. Actually, you know what? I'll go to that one first. Here, we'll go backwards. Anyway, so about 20, and the average, no such thing as average. I get it, but still, your average bull market lasts about 5 months. I'm sorry, 5 months, 5 years, about 60 months on average. So again, you could argue, and this is what we are arguing, this bull market is still relatively young, reasons to think it has time to go. now going backwards to where I just was. 1 year, remember I came on with you, we talked about this. 1 year off those lows, October of 23, 1 year off the October 22 lows, up only 21%. One of the worst starts to a bull market ever. Everybody's knocking it. We said, you know what? Maybe there could be some catch up because off the 87 bear market, we saw 1 year kind of low, and then the second year really played catch up. And we think we're seeing that. Now, clearly, this year 2 expires, if you will, in October. So you can see here 2 years off the lows, you're up about 58% on average. This one's up about 48, 49% on average so far, with time to go until October. So again, just reasons in our opinion to think that there still could be a summer rally, if you will, in this election year. Here's one I've shared before, but lame ducks, I use a little emoji of a duck there. Lame ducks are bad, meaning the second half of the year when you have a lame duck president, stock market doesn't do that well. Yes, it is skewed by the great financial crisis in 2000. I'll be honest. So maybe you could say small sample size, but bottom line is just, again, something to think about. And why is that? Believe me, I could talk for an hour on this. Markets do not like uncertainty, as we all know. We have the next president and a current president. I don't think the market's going to be overly surprised whatever happens with the next president. That's kind of why we think markets tend to do okay when you have up for re-election. This is cool. I work with a guy named Sonu Varghese on our team, do a podcast with him, Facts versus Feelings. Sonu's one of the smartest, nicest guys in the room. He looked at 178 components of core CPI. Just remember, PC. PC came out last week. And this is a little confusing, but I'll just explain it. He looked at all of them and did like this plot here. We're seeing outright negative year-over-year inflation on the bottom.
Wow.
30 components out of 178. So when you hear, inflation's stubborn, there's a lot of parts of inflation that are really, really improving. Okay. And we know what's going on. It's because of shelter. It's because of financial services, my industry, our industry, charging a little bit more. Why are we doing that? Because stocks are up like 20% the last year. So that wasn't really factored in. And auto insurance, those things we think are going to come back. And we're seeing under the surface. We talk about market breadth all the time. Well, market breadth, in our opinion, on inflation is really improving with a lot of things, seeing negative year-over-year inflation. Just a couple more. The consumer, obviously, has been marked dead many times. This is another cool chart that Sonu put together. He looked at assets and liabilities. Okay, big deal. There's a lot of assets, a lot of liabilities. You've got to normalize it, right? Denominator blindness. We do it by disposable income. Doing that, guys, on a percentage basis shows assets, that's the part on top, is the highest it's been, in 25 years. So people own a lot more. They own stocks, they own houses, they own, cash getting 5%. So people are worth more. But then you hear, oh my goodness, what about that liability? Liabilities as a percent, and you see it there at the bottom, liabilities as a percent of disposable income is the same it's been for 25 years. So yeah, there's more debt, there's more liabilities, but people are worth a lot more. This is a way of showing the balance sheet of consumers, and we get it. There's different income brackets. People are struggling, but overall, your average consumer is in pretty good shape. Here's one that makes people furious. This breaks it down by which one is it? A percentile of income percentiles. Bottom line, lower percent people make less money. Honestly, I've seen bigger improvements in their liabilities relative to their assets. We've seen it across the board, but you hear all the time the higher inflation, higher rates, and it is hurting people. We're not naive to that. But overall, there are risk data straight from the Fed. There are some improvements under the surface. They got like two more. Bankruptcies, right? Their bankruptcies are running 40% less than they were in 2019. 40% less in 2019. If the big monster was coming, we would expect to see bankruptcies, and honestly foreclosures are on her too, start to spike up. I mean, check it out. For years in 2005, 6, 7, we saw this spike before the you-know-what hit the fan in 2008. So again, we're not seeing bankruptcies or foreclosures yet. Then this could change, but we're not seeing that yet. Two more. There are cheap parts of the market. And we get into this if you want. We've overweight small caps by a little bit, but by a good deal overweight mid caps, because those are some cheap areas. We've been neutral tech. Doesn't mean we don't like it. I want to be very clear, but we haven't been overweight technology. We just think it's quite pricey, and this is one way of showing it. Then this is a different way of showing sectors. We like financials. We like industrials. Some of the cyclical areas, which honestly aren't all that expensive either, which are good. And this is my last one. I've shared this with you, I think, every time, but I'll keep doing it. If you invested just in a Republican president since Eisenhower, you'd have about $27,000. Okay, if you started with 10,000 or 1,000, you started with $1,000. Okay, it's 1953. That same $1,000 would be worth over 60 grand if you did only Democrats. Okay, a little bit better under Democratic presidents. If you just stayed invested the whole time on the S&P, you'd have 1.7 million. Wow. So yeah, just something to think about there. So I talked a ton. I know I went fast, but there's a lot there. Did I stop sharing my screen? I think I did, right?
Yeah,
you did.
All right, guys.
I need to get my time machine and go back to.
So there we go.
I need to get my time machine and go back to the 50s and invest $1,000 or $10,000 in the S&P.
Oh my goodness, you're not kidding.
Just goes to show you, if you're along, like, I mean, I love your charts always, Ryan Detrick. You do such a fantastic job, but it just goes to show you that if you're a long-term investor and you're listening to the show, like, enjoy, but stay invested in good companies at reasonable valuations, and the results speak for themselves. I mean, now some of us are traders, and we're going to buy, and we're going to sell, and we're going to do other things. But I try to hold that long-term core portfolio just to try to get that performance that you're talking about. And the things that I do wrong, Ryan, more often than not, is selling stocks in my long-term portfolio. Like, I look back at what I've owned, and I wish I would have never sold anything. If I still had all those stocks that I bought back in 1999 and 2000 and 2001, I remember I had like Microsoft, like I owned like 500 shares of Microsoft back in like 1999. Like, I mean, and then it went down, and you're like, in 2000, 2001. But if you held through all that, just think about, man, that's what you got to do. You're a long-term investor, just hold on.
Well, the other one is Time Man of the Year 99 was Jeff Bezos, right? And then Amazon stock goes down 86% during the tech bubble and implosion, and now obviously it's Amazon. So I'm with you, and of course I'm a market strategist. So I try to teach about the long term and things, and I look at tactical things as well. But I'm with you. I talk to a lot of people, and so many times I hear, "Well, I sold in 2009, I sold in 2020. What do I do now?" I don't really have the best answer there. Don't sell this time. Stocks are down a lot, but I mean, I think it's important. It's also important to point out that there are cheap parts of the market. I mean, we added some gold, just a little bit tactical models, some gold back in March of 2023. I've been bullish the whole time. You guys know that. But there's some reasons to think that, maybe gold could do well. Right now, guys, we actually added treasuries back in April for the first time. And I've worked at Carson Group because we haven't liked treasuries. But this whole swing of, and this is the earlier conversation, Aaron, with 6 or 7 cuts, and then 2 months ago we're hearing maybe no cuts. We're still think, like I showed on that inflation chart, that there's a chance for some cuts, but the pendulum swung too far. So we added, we added a little, getting geeky, we added a little bit of duration in the models that we run. Oh, yeah. We've also added some diversifiers, right? We've added some gold. We've added some other areas that maybe we look at kind of like a proxy to bonds, but not pure bonds. We're still overweight equities. But again, we added duration for the first time in a while because I think yields are going to go lower because I think everybody went on the other side of the boat again. Do you see the cover of Barron's this weekend? Why there won't be cuts? Hey, they gave all the fundamental reasons, but I think they ignored some other things that inflation is still going to improve a lot. That's our base case.
What about small caps?
Yeah.
I mean, they just haven't participated. I know Dennis put some stats in about going back a couple years. I mean, song remains the same here. What is it going to take that? Yeah, just hate it. I mean, it's just not this place not to be. Yeah. And I know you've been sticking with them, but I mean, are we going to have to wait for a rate cut? I mean, or is it just it's just the way it's going to be? It's just the way it's going to be.
I think we do. That sounds like, or looks like, we're probably going to have to wait for a rate cut. It feels like the Russell 2 is always right around 2,000, right? I mean, it's like, isn't it? But yes, I mean, again, that's if you think about talking about the long-term investors. I know a lot of traders on this program, obviously, but small caps are historically cheap relative to large caps. Last time they were this cheap on like a book value and PE value was like 99. Small caps outperformed for like 13 years after that. That doesn't mean it's going to happen again. I want to be very clear. But again, those are very underloved, like we said. But honestly, our biggest bet, the biggest bet that we've made in the money that we run, we manage over $2 billion for our Carson partners, has been mid caps, right? Mid caps are kind of that Jane Brady area. They're doing pretty well. And mid caps have done better than small. We get it. Not quite as well as large. We're aware. But again, we're just optimistic that there's not going to be a recession. The economy, these recent economic data we've seen, some of the cracks. I mean, again, it's like the surveys, the manufacturing surveys. You look at the hard data, it's not quite as bad. We don't see a recession. We think earnings, again, will be pretty strong here. And again, that means, well, why we like the cyclicals, why we like small caps, why we like mid caps. Those are the areas we've been overweight. Now, I'm believe me, small caps have been frustrating. One other thing to think about, I mean, I know we all remember this. The last 2 months of last year, the Russell 2 gained like 25%. I'm going to ballpark that. It was somewhere around. They gained over 20% in 2 months. I looked at the best 2-month rallies ever. Okay, 10 of the 10. That was like the third or fourth best. Go by memory here. But looking at the all best 2-month rallies ever of the Russell 2. A year later, which again would be like December next year or this year, was higher every time, 10 out of 10. And the average return was like well over 20%. So you got to still think, are we consolidating that record rally we had at the end of the year? Of course, I'm biased. I think that could be some of it, but we still think there's some reasons to think that in the end, small caps will do pretty good. I mean, from right now to the end of the year, I feel pretty comfortable saying I do think small caps and mid caps do a little bit better than large caps, and I think large caps do just fine. But we do think there's some opportunity there. And again, they are hated, no doubt about it.
Like mid caps. Which sectors are you thinking mid caps? Like the banks? Like where are you thinking when you like go into a couple sectors, just mid cap sectors for us?
Yeah, I mean the same sectors I mentioned, but you're right. Banks, financials, industrials. I mean those cyclicals. Those are the areas that are looking pretty good. Honest to goodness, you look at earnings growth expected. I get it. Expected it could change. I'm aware, but there's a good deal of expected earnings growth from small and mid caps over the next 2 years. I mean that's where a lot of the growth. We all know the Mag 7. They've done wonderfully. Nvidia, all that stuff. You get all that stuff, but I mean there's a broadening out of earnings that we really do expect as this economic cycle ages a little bit, but also starts to benefit some other areas. But yeah, our two favorite areas are financials and industrials, and mid caps. That's exactly where we are with those areas. And again, you could argue, at least with banks, a little bit. I mean, some of that is if the Fed were to cut a little bit. I mean, the bottom line with banks, in our opinion, is if the consumer is in trouble, yeah, banks are probably in trouble. I think it makes sense, right? But we just don't see that yet.
Ryan, real quick, because you mentioned, looking at this bull market to continue for a little bit longer, you have, a lot of the mega caps at all-time highs. At what point, what would be the signs that you look at when maybe the market does start to look a little toppy or that euphoria is driving the market? Because right now, I saw it the way you do that. It's like, sure, Nvidia's at all-time highs, but I don't see it as like this bubble top. It's kind of orderly moving up like every single day a little bit. When does that change? What would be your sign that, okay, now we're overextended?
Yeah, well, Nvidia is amazing because I mean it's literally like cheaper than it was a year ago.
Right. That's why it's people are like, oh my god, this is a bubble. I'm like, no, you're not looking at the valuation. It's
Fundamentals.
Yeah, I saw. I didn't read the article, but Market Watch had a thing about looking at the 10 biggest bubbles of all time or something. Almost like I didn't read the article, but like almost implying we're in a bubble now. Like I don't know, earnings are justifying. I mean, the things I like to look at are advanced decline lines, NYSE advanced decline lines, if small cap advanced decline lines. All these are making new highs just 2 weeks ago, right? 52-week highs on small caps across the board on different advanced decline lines, and then credit markets. I mean, everybody talks about the yield curve inversion. I've come on with you before saying no, we don't think it's necessarily the end of the world, and here we are over 2 years later. It inverted. Let's not forget April Fool's Day of 2022. You can't make that up. That fooled a lot of people. But the credit spreads have remained tight. I mean, we're not seeing stress in the credit market. So until I see stress in the credit markets and breaking down in various advanced decline lines, which I'm gonna be clear, I'm not seeing that yet. That's when I think we'd be more worried, and we might move from overweight equities to more even weight. But we are comfortably overweight equities 2 months ago in April when we had that pullback. Whatever that was in April, we had that pullback. We sold a little bit of high yield. We've been in high yield. It's done well. I mean, believe me, high yield's done a lot better in treasuries last I looked. So we actually sold a little bit of high yield, added more to industrials, and added more to financials on that little pullback we saw in April. Again, as we think those are still the areas that'll do pretty well.
Well, all right, Ryan, it's always great to catch up with you. You always come with so much knowledge and stats and information. Great to hear your perspective. Any final thoughts you want to leave us with?
I saw Ohio State's favored by 10 against Michigan. I would take. I don't buy that. I don't know. We haven't talked about it yet, guys. But I'm not. I know. Believe me, I'm an Ohio State fan. I don't think I'd take Michigan with 10 points.
Well,
I
retired.
We'll see.
I pretty much have retired from sports and being a huge sports fan. Won a national championship.
Yeah, you go out on top.
I don't know. Yeah. We're just gonna run the ball the whole year. I don't know if we're gonna throw any passes and see if people can figure it out. Just one quick question: are you worried about Joe Burrow?
Well, I saw he took yesterday off, but hopefully not. I mean, I don't know. I think I'm more worried about our wide receivers wanting more money and seeing all these other wide receivers getting paid. That worries me a little more. But no, I think Burrow's just taking a day off. They said he's looked really good, but again, everybody looks good without pads on. You got to keep him upright. That's the problem. But I'm a homer, so hopefully Burrow, he's had the best doctors in the world. Hopefully he'll be all right. So just get our wide receivers signed and get them in camp. That's what I'm worried about.
All right, Ryan Detrick, Carson Group, joining us here on PreMarket Prep. Great information.
Thank you, Ryan.
That slow leak was a mirage here. Back up at the highs of the session. Dennis, buy imbalances.
Buy the dip wins again. No imbalances. No, nothing. It's slow. It's not the driver today. Some
No?
days you come in, you can say, "Oh yeah, we got some buying balances, drivers." Nothing. There's nothing there. Some are
Nothing.
small, some big, or there's no big ones. Some small to
There's just no
sell, small to buy.
resistance.
Nothing
That's the
burger.
problem. There's just nothing in here up till another 14, 15 handles for your neck. That was the weekly high. So,
There's still
yeah.
FOMO out here. Like you still
Yep.
got FOMO in a lot of stocks. You know, you're looking like again, we keep coming back to Nvidia. They're like, why do you keep talking Nvidia? Man, that's the thing that's working the best. So we talk about what's working the best here. Other things, obviously there's a lot to talk about here. We didn't touch on the Keith Gill GME stuff here today. I wouldn't mind touching on it here because, GameStop's trading down. Now, apparently, there's regulators investigating, Keith Gill here. We talked about a little bit about this yesterday, where I don't think it's Morgan Stanley's place to be, looking into accounts and, doing stuff. And I don't love that. But at the same time, regulators can have the rights to look into whatever they want. So, regulators are looking. People are like, is he in trouble here? My take, just my quick take, and you can give your take too, is it illegal to buy calls? No. Is it illegal to post your position? No. Is it illegal to post a meme of an Uno card? No. If there is intent and they can prove the intent that all of this was done to manipulate the price higher, that's where trouble would start. And the way they would prove intent is by regulators come in, they'll look through all of your personal message, your cell phones, your chats, everything. If they find any type of collusive messages saying, oh, yeah, we're going to come in here, okay, so here, buddies, I'm going to go buy a whole bunch of this stock and, I'm going to pump it tomorrow. If he said anything like that, he would be in big trouble. So, but if nothing is said, I mean, is the intent there to drive it higher? Logic says it is. Can you prove that intent? That's a big issue for the regulators to try to prove that intent. That's my thought.
And I think that's going to be the hurdle, is because even if from a common sense standpoint you look at it and you're like, okay, well, why else would you be posting these memes and stuff on Reddit other than to influence it? It's I think it would have to go further than that in terms of like
go further than common sense.
Yeah, exactly. And so that's what I think might be. And then my point that I made was Keith Gill's already kind of been through this, right? After the 2021 rally. And I was actually reading up on it yesterday. I didn't realize how quickly the pieces were moving in this. Like, if you remember back to it, the rally happened in like January 2021. By the end of February, Keith Gill was testifying to the House Finances Committee. So within like a month of GameStop rallying, he was testifying to Congress and having to answer all these questions to lawyers and all this stuff. So part of me thinks, okay, if he's already been through this and he kind of knows the drill, he might have a better idea of what exactly he's allowed to do and what he's not allowed to do. The other side to that, which we talked about, Dennis, was that maybe because he's gone through this before and got off on it scot-free, he thinks, oh, I can do this again. No, no one can touch me. And then this time he maybe does something that he didn't do last time. I don't know. Either way, I think we just got to let it kind of all play out.
Anyways, obviously, he's loved in the social media world. He's seen as a hero. I'm not going to comment on any of that. I'm just going to say that regulators are going to have a trouble probably proving that intent, even though common sense says that's what he was trying to do.
Yeah. And then so the other thing that happened while we were doing the show, kind of some breaking news. So we did have news that Amazon, ESPN, and NBC are signing a deal with the NBA for a $76 billion TV deal. So I don't know if we saw Disney stock move off this or Amazon stock move off of this. But either way, from what I can tell, this would be the biggest TV deal in sports history. $76 billion. There were some, I just saw someone was tweeting that, oh yeah, this is coming from a hedge fund hedge funder on Twitter saying no Warner Bros. Discovery. And then they were calling out one of the executives there, Zaslav's, because I guess Warner Bros. Discovery was talking about getting the rights to NBA games, but they are not included in this deal.
Neither stock really moving much on it here. I mean, the
Okay.
market's up. That's why Amazon is up. Disney stock is starting to show, it's starting to be productive here at $100, Joel. I mean, it didn't get through there. It's starting around. It's starting to show a little bit of life here. I just don't see, I think Disney, and I've been bullish Disney before. I've been bearish Disney before. I've been all over the place. I've had this in long-term portfolio. I've sold it. You know, I've done well in it a couple of times here. I've said on this show, if it got back down to 90, I would probably be a buyer. We didn't get down there with 103. Does it take off from here? There's an AI play in here for sure. You know, there's obviously, you know, we talked about the metaverse before. I think, you know, nobody talks about that anymore, but I think there's a play. There's lots of plays in here for Disney. The problem is if the economy slows down even a little bit, the parks are such a big piece of Disney that it scares me to think, well, we've been firing on all cylinders, economy has stayed strong, the park's been packed, and the stock really isn't going up. You know, I feel like AAL kind of again, you know, where you're in something and the valuation's okay, and Disney's valuation isn't even that cheap. I think I'm just staying away from Disney for now.
You have an identifiable area of support here, trying to fill the gap from the February earnings report. And, that's a constructive base. That's, the bigger players stepping up at 100, 101. So you got a little area. But Disney, man, it will be in these ranges. And right now, looks like the bottom of the range is just above like 100.60, 100.70. And then you got a little bit of the top of the range right here at the 104. So several highs in the 103, 104 handle. So let it shake out of there, right? I mean, consolidation came down, let it move up. You have identifiable out here if you want to risk under $100. But right now, you break above 104. I think to be a little bit of market dependent too. You get blast up to the all-time highs. It's taken along with it, but it's like you said, it's not sexy. Like Disney's not.
Not right now.
Where's the AI? Where's the explosive earnings
Not
growth coming from?
there. It's gonna be there, but it's not there yet. I've envisioned before, like having the parks, you don't have to get a ticket on a flight to go get there. The park just comes to you. I mean, you're, involved, like metaverse type style. I think that can be there eventually, but we're a long ways away from there.
Look at our boy Christian Fromhertz. He's like a sports reporter now. Look, he's got like one of the most liked tweets on this subject. 14,000 views, 31 likes. NBA near $76 billion deal with NBC. I don't care that he put Wall Street Journal here. I'm giving Fromhertz the credit on this report.
He's breaking news. Fromhertz breaking news.
All right, guys. It is 9:03 a.m. Eastern. Joel, what do we got going on tomorrow?
Mr. Chaikin. We will be talking to Mark Chaikin of Chaikin Analytics. He'll be joining us. We haven't had him on 2 weeks, so he'll be on to give us his bullish outlook on the market. So we'll be talking to Mark tomorrow as far as the S&Ps go, as far as the market goes. Well, just look to your highs from last week in your stocks because we could be there in a jiffy. But right now, everything's starting out in the green. Let's see if that continues here on this Wednesday.
All right, guys, great show.
Did you ever look up the definition of a jiffy? What the moment is?
I know the popcorn, the Jiffy Pop.
I'm looking it up here right now. I believe it's 1/100th of a second is a jiffy. So maybe they should change the saying to like a millisecond or something, or like a smaller increment there, because 1/100th of a second in this high frequency trading world doesn't seem that fast anymore.
No,
could be food for thought.
Food for thought.
I'm probably the only one that uses that word.
I think so, Joel.
Yep. All right, guys, great show today. A little bit of a slower news day, but always great to catch up with Ryan Detrick and talk about the market as we again edge toward all-time highs. We'll watch that today. We will be back tomorrow, 8 a.m. Eastern. Make sure you are there. We do have live trading starting up right after this. Make sure to check that out. Stay green. Peace and love, y'all. We'll see you guys tomorrow morning.